All right, gang. So in this strategy course, we're going to cover the long call strategy. So the long call strategy is designed when you have a very bullish outlook on the underlying stock, meaning that you expect that stock to make a strong move higher in a short period of time at the same time. So what we're going to do here is going to show you guys how to execute this particular strategy. And then after we do that, we'll analyze it and get into some of the mechanics. So what I want to do is actually first I want to take my strikes down just a tad bit because I want to show you guys a little something about time. Okay. So we're going to go to the monthly expiration periods, and I'm going to pull up the 20-day series, and then I'm going to pull up the 55-day series side by side so you can see the difference between the premium of the options themselves and why this is important. Because in this particular strategy, it is a bullish strategy, and you're entering as a buyer. As a buyer, buyers have to pay for time. This is important because time is the enemy of the buyer. And so when you want to afford yourself some more time, then you go further out in time, and then you actually buy those contracts instead. What you will see is that those contracts are more expensive. For instance, if we take a look at the at-the-money 280 strikes right here, take a look at the mark price. It's $11.29. If we go 55 days out, it's $17. Okay. And you will notice this as we continue to go further out in time, that those same strikes are more expensive. They're $20, as you can see on this one. So further out in time you go, if you want to give yourself some more time to be right on your strategy, you're going to pay a premium for it. So just keep that in mind. What we want to do is actually go to the 20-day expiration series here. Okay. And to execute this particular strategy, let me put us back to 50. We want to get as close as possible to around 60 to 80 deltas. So this is how you execute this particular long call strategy. You want to execute it somewhere around 60 deltas to 80 deltas. You don't have to be so rigid in your approach. Just know that you want to range around 60 to 80 deltas. The sweet spot is 70 deltas. So we have a golden rule that we want to, when we bind the long call strategy, you buy at the delta 70 or as close as possible to the delta 70 as you possibly can. So we'll go here to 72, and then I'm looking at my open interest, and it's really low in comparison to everything else. It really sticks out like a sore thumb. It's low. It's only 164, where everything else is thousands. And then I got 69 delta that's at 6,000. Then I have a 75 delta that's at 4,300. Okay. So what I'm gonna do in this particular case, I'm gonna just go with the 75 delta. And what the 75 delta is going to do is going to signify the probability that this trade is going to expire in the money, which is where we want it to expire. That's the outcome that we want for this trade to basically come out to. And so with 75, that just means that we have a 75% probability of being right. Okay. So we want the math on our side. So we want to aim for the delta 70s. Okay. And one of the things that new traders like to do, newbies, they make the mistake of buying cheap out of the money calls for this long call strategy. But they'll go out here and they'll buy the delta 12. Now that just means you have a 12% probability of being right. But this is a real waste of money. Okay. Also, the delta signifies every dollar that the underlying stock makes. That's how much money our options are going to make. So we can make 75 cents on the dollar. That's as close as to a dollar move that you can get. And remember, the deltas have a maximum movement of a dollar anyway. So we're above the 50% range. We're at 75, which is good. If you come out here to cheap out of the money ones, you're only making 12 cents on the dollar. So even if the stock makes the move that you expect with the direction, you're probably going to lose money. So this is not good. And this is why a lot of newbies without training, they get in the game and they lose money and they quit. So the golden rule is to buy right here around the delta 70s. Okay. Now, another key thing to remember is that when we get into this particular strategy, for one, the underlying stock, we have came to some kind of consensus, or we formed the bias that that stock is going to move higher. Where do we get that from? We get it from the charts. Okay. So that's going to be in the technical analysis courses when you're assessing these stocks and forming biases on direction. So for one, with the direction, this trade here is easy to get into, but it's harder to manage. And that's another thing. So it's an easy to execute trade, but it's an advanced strategy just because it has so many different variables. It makes it harder for you to be successful with this particular strategy. So the stocks, they can either move up, they can move sideways, or they can move down. In the long call strategy, out of all three of those different scenarios, you can only make money one way, and it has to be the direction that you're choosing your bias. So in this case, we have a bullish direction. So this stock has to be bullish. Okay. So direction is one piece of the puzzle. Timing is also another piece of the puzzle. So you have to be right with your direction, and then you also have to be right fast. Okay. And then you also got to get the volatility right as well. So if we take a look at the chart, we just take a quick glance. Let's just say we believe the stock is going to move up. That's what the chart is telling us. And then we pay attention to our little implied volatility, which is telling us that this particular stock, the volatility right now is low. The implied volatility is low. And what that signifies is that the prices of the options are fairly priced. So they're low price. So we're, as a buyer, we want to buy low, we want to sell it high. So we're buying at these great prices with the expectation that the volatility is going to increase. And so therefore we can make money off the volatility increasing. We'll also make money off the prices increasing as well. Now, the key thing on this strategy is to remember that time is the enemy. So every day that goes by, you are losing money. So you're in a race against time. Okay. So how we execute this strategy, we go to the Delta. We're going to go to the Delta 75 in this case. We're going to right click it, and then we're going to go to buy strategy, and we're going to go to single. So when we hit single, this is a single leg trade, okay, a strategy. And what we will do here, we're just going to leave it simple at one call here. We're going to leave everything the same here. And what we're going to do is hit confirm and send. And in the confirm and send dialog, it's going to give you all the information that you need. So you really don't need to pull out calculators and all of that. But we can get into the math if you like. So in this particular strategy, it's going to tell us the break-even stock price. So by the time this stock expires, by the time this option expires, which is in 20 days, the stock, underlying stock, must be at $287 in order for you to break even. Okay, that's just for you to break even. So we already know this thing got to move $5 in order for us to break even, right? Now, this is a very attractive trade because the max profit is infinite. So a lot of new traders like to get into it because it says it's an infinite profit potential. But there are no stocks that move infinite amount. Okay. It's just theoretically we don't have a ceiling, so it can move theoretically unlimited. However, it's gonna hit some kind of top, but we don't know what that is. Just know that we have unlimited profit potential on this thing, which is very attractive. That's the reward. So we have an unlimited reward. The max loss will be the debit that we paid to get into this trade. So if you look down here, we can see that right now I'm looking at $22.35. If we bought this right now at this price, then that is the debit that we paid. So remember, buyers pay debits, sellers receive credits. We're buying, okay? And so because we're buying, we are paying a debit. And remember, the long call is called long call. Long does not mean bullish. Long means that that's the action that we're taking, which means that we're buying. If it was short, then it means that we're selling, okay? We can buy and sell and be bullish or bearish. So don't confuse the two. It's called long call because the action that we're taking is buying. And because we're buying, that means that we're paying a debit. Now, when we pay a debit, there are no margin requirements, okay? So that means that the maximum that we can lose is the amount that we paid for the option itself. So it doesn't matter what happens. The worst case scenario, it don't matter if the stock falls off the cliff, off the face of the earth. The max that we can lose is the money that we paid into this particular trade, okay? And if you look here at our order confirmation dialog, it also factors in commission, cost of the trade, including the commissions. So commissions used to be a big thing about a year ago, but now it's no longer a big thing because the commissions are basically $0 across the board with pretty much every brokerage firm. But you also still have to pay for the leg of the trade. So they may not tell you that. So yeah, is zero. Commission is zero now, but you still have to pay for each leg of the trade. In a single call strategy, it's only one option. It's only one option leg. So in this particular brokerage right now, they're charging 65 cents. This could change in the future, but right now it's 65 cents per leg. Okay, so $0 commission, that's free, but you pay for each leg of the trade. So this is one leg trade, so we pay 65 cents. So we just take that 65 cents and subtract it from, and add it to the debit that we're paying. So you see the debit that we're paying plus the leg and the commission, and then you get your total, the total that you're paying on this particular trade to get into it. Okay. Now pay attention to this. If I add more contracts, you'll see the leg. You'll see that this part of the payout that I have to pay is going to get more. So 65 cents per leg. If I add another contract, you'll see. If I add another contract, and you'll see that that goes to $1.30. Okay, so the more contracts you add, the more that you have to pay. That's your commission in the leg of the trade. All right, so that's pretty much everything that you need to see here on the confirmation dialog. It's also going to tell you like how much your particular stock is going to, how much this particular position is going to impact your total account size and things like that. But basically what we want to identify is the maximum potential profit and the maximum risk that we have involved before we get into the trade. And that's what I like about options, because we know in advance our maximum risk, which allow us to manage the risk. So to do that, what I want to do right now is just right click here on this particular trade. And then we're going to go to our analyze trade. Bingo. And go to the analyze trade tab. We're going to see our profit loss grid here, which is going to give us a graphical illustration of how this situation plays out. And then we can actually begin to calculate risk in this particular trade with the strategy, with the Greeks, and see how this thing impacts, our particular position here. So what I want to do is let me actually get this. It tells me right now that if we get into this trade at this $22.35 price, then we're going to open this trade at a $300 loss. We don't want that. What I want to do is dial back to one contract, and then I want to pay a lower debit. Let's see. We're going to get close to zero as possible because I want you guys to see how this works theoretically. All right, so let's say we pay $20.85. That's about as close as possible to $20.80. Let's say we do $20.80 here. Okay, so that means we're entering into this trade positive $3.65 as soon as we get in. So in this profit loss grid, what it's telling us from the left side, okay, if this stock moves to the left, which you see this blue line in the middle, that's telling us the current price that the stock is trading at right now. If it moves to the left, which is lower, the stock price drops, the underlying stock price drops, our commission, our options that we pay for is going to be losing money. And if we look at the break off, when it flatlines right here, we see this little tab right here. We'll see that it stops moving because that's the maximum potential loss. So it's saying negative $2,080, and I don't know if you can really see it there, but it's the same debit that we're paying down here. So that's just telling us that it doesn't matter if this stock falls off the cliff, that's the max that we can lose. It's negative $2,080. If we come from where the stock is trading right now, move to the left, we'll see how much money we can potentially lose. Okay, and so the green one is the pricing. That's the price, and then the blue line is basically the timing envelope. So the time, the extrinsic and intrinsic values moving together. All right. So if the stock moves to the right, we can see that starts to increase. We can see our profit potential starts to increase higher and higher, higher. The line goes all the way up to the top, and it represents infinity. Okay, so it can go as high as it possibly can go, right, which is infinite. And you can see in this particular strategy, as I move close up here, I'm showing $6,000 or what have you. So you can make big money in this particular strategy, okay? In the long call, you can make a lot of money. It is a jackpot play. When you see a lot of options traders making big money, they're normally coming from this particular strategy here, okay? So because when it moves and all the stars in alignment, which are the Greeks in this case, then this really pays out really awesome for you, okay? Just understand your maximum potential risk. In this one, it goes from on the left side, which is the debit that we pay. Now, we can see the break-even marks here, which are red on these little red lines here. This is the break-even at expiration. So, again, we was talking about if you held this thing until it expired, what does it have to break? In order for us to break even, the stock has to move this way. It has to move, about those $5. So it has to be right here at around 286 in order for us to actually break even. And then anything to the right is going to be profit. And this is by expiration, okay? So they're just looking at that from expiration. Now, on the Greek side here, this particular strategy is delta positive, okay, 75 deltas. Gamma is positive also. So when the stock moves up, this is great for this particular strategy. Now, theta is negative. So that means every day that passes by, theta is going to eat us alive, okay? So we have to worry about the time decay, which is theta. Vega is positive, so Vega is going to help us out as well. All right, so Vega, volatility, we want for volatility to go up. As volatility go up, we're going to make money. As price go up, we're going to make money. as time gets closer to expiration, we're going to lose money. Okay. So if we just take a look here, we're at what, 365. Let's just take a look and see if the stock moves up in price. Let's just move it up $1. We'll see that we made $79 there. Okay. Because again, we got what, 76 deltas. So that's close. That's expected, right? And then we move 2 and you just double it up. So if the stock moves $2, then we make $156. And so that's a small price change for this underlying stock. But look how much money you'll make on the options if you choose the right delta, which is, again, around that delta 70. And so this particular trade strategy can be really helpful, especially for even day trading, okay? So whenever I'm day trading, there's normally just these here because I have a very, very strong bullish look and I'm playing a direction, okay? Now, if this thing move against you, bingo, you're losing money fast as well. And you know the saying, trouble is easy to get into, but it's hard as H to get out? Okay. That's the problem with this particular strategy, because if you get the direction wrong, the timing wrong, the volatility wrong, all those different things are going to eat you alive quickly. And so that's why I say that this strategy is a hard to manage strategy. It's actually an advanced strategy, although it's easy to put on. This is the long call strategy. Okay. Now, let me actually show you guys. I just showed you the price movement there. Let me show you what happens as time starts to pass. So we'll just take a look at how the theta impacts our premium, our profit. Every day that passes by, we're losing money. So whether the stock moves or not, we're going to lose money every day. And theta grows. You see how big theta started to get when we started moving closer to the expiration. So that theta starts to grow. It starts to eat up the premium exponentially. So it's important that you get in and out of these trades before they expire. Volatility, if we take a look down here, if we just type in here, let's just say 5% volatility, bingo, we can make like if it moves 5% volatility, we make $100 just in, the volatility side, right? 10% volatility, right? Just off of volatility movement alone. Now, let's say we combine all these elements together. Let's just say we take away 2 days, 3, 4, 5. Let's take it away 5 days. So we're going to lose theta. But let's say the volatility increases by 10. Let's just say the price increases by $10. The underlying stock does. Bingo. Now we made $864 off this particular trade because we got the direction right and we got the volatility right. Okay. That's how this thing works out. So that's the long call strategy. It's a beautiful play. Now let me actually take us back to the trade tab. Because when you execute this trade, just understand that you want to execute it in the money. And by expiration, you want it to be in the money. So those are the outcome that you want. Now, we have no intention on exercising our rights to own the stocks. The stocks. If you want to buy the stocks, then you will let it exercise in the money. And you can take ownership of the stocks at that price, which in this case is $265. And so you would basically, have to have, $265 times, 100, which is going to be the $26,000 to buy those shares, basically. Okay. We do not want that outcome. We're just trading the contracts. We're going to make our money. And we're going to get out this thing. So that's the whole key. That's the long call strategy. So I'll see you guys in the next class for the next strategy. Peace.